The best investment analysts are wrong a third of the time. This is something that George Templeton has said quite often in his track record of speaking. And this is something I want to touch up on because I think a lot of people underestimate this factor and the importance of it. So if he's saying a third of the best investment analysts are wrong, I believe it's more likely to be around, you're wrong 40, 50% of the time. And that's okay. I think that's part of the game and understanding. But you should still obviously take the steps to prevent that from occurring. But whether that's just due diligence on the company, understanding the balance sheet, and there's certain checklists for mistakes that you've fallen into that you're prone to, that you should write down in a checklist. Now that comes with experience, comes with time, and something you'd pick up over after a while. But the main thing I wanted to state was that if we know that the best investment analysts are wrong a third of the time, and we make that as our assumption, then surely we should be paying a heck of a lot more attention to the downside, the risk, what's there. And this is something a lot more newer investors make a mistake in doing, is they underestimate the importance of the downside. So I now always, whenever I look at investment, I look at what's the worst case scenario that can occur and what can protect that business. So for example, if it's in a highly cyclical industry, I assume that there's going to be certain years where the business is unprofitable, they're losing money. Then I say, right, so how much debt have they currently got? What's their cash position like? Can they sustain 2-3 years of unprofitability? And what's their assets relative to their liabilities? Could they sell off some assets to fund the business essentially? These are all risks that you need to take into account, and at least that way, if you are wrong 40-50% of the time and you still get that percentage, well, at least you know that your business isn't going to zero. It will go down 50%, 40%, but it's not going to go to zero because there is some margin of safety there. And that's not just taking off 30% off the intrinsic value. It's to do with the actual business itself. Is there anything that's protecting the business in that sense? Do they perhaps have a very high margin aspect of the business which isn't as cyclical, and that can sort of protect the business in itself during those periods where the other part of the business may be suffering large losses? So it's factors like these that you need to take into account as well to reduce your loss ratio and how much you lose every time as well. I think that's something that's really important to take into account. That's all.